Hello, hello, everybody. Welcome to today's webinar. So excited to jump into today's topic, which is the 2025 economy and forecast. And we got a lot to cover today. We have an amazing turnout. So thank you all for joining live. I know a lot of you couldn't make it, so this is recorded. We'll share this as a recording later on. But before we dive into it, if you've been following us for any length of time, you know how important this is to how we operate at Aspen. We look at the big trends, what we call the mega trends, that we believe are going to be in play and be a key part of an investor's understanding of where to invest for the next several years. And so really excited to do this with Bob Fraser, one of our co-founders and our chief financial officer, and really our chief macro strategist. He's been following the economy, been following trends for over several decades now, and with pretty incredible accuracy over the past several decades. If you've been following us, you know this is really good content. This is probably our highest rated content and what people ask for all the time. Bob's going to be presenting these very slides at multiple conferences this year. So you're going to really enjoy this. And again, this is our playbook for 2025. This is how Aspen is looking at the economy and looking at the opportunities, and we want to give it to you. And if you want to participate with us in what we're investing in this year, we invite you to join our investor club. But you can take all of our research here and use it to your benefit, however you like. We'd love if you want to join with us. So we'll have some throughout the presentation here, ways for you to join our investor club if you're not already in that. That gives you early access to our deal flow and insights and content that we put out throughout the year. So with that, let's get Bob to the stage here and start the presentation. Bob, you excited?
All right. Yeah, I'm pretty pumped about this. And for those of you who've watched this for a while, you know a lot of the presentation is similar to the previous one always. That's because nothing, really, I look at the big trends and a lot of things haven't changed. Well, this time a few things are changing. So it's kind of interesting. But yeah, we've been doing this how many years, Ben? And a lot of years, and with pretty good accuracy. But as Ben said, this is our playbook. So I literally spend this time for myself and for my company, Aspen, to figure out where we want to put our chips in this new year, and where we want to look for the outsized opportunities. And so this is our playbook. This is how I'm going to place my capital this year. And we love to share our playbook with anyone who's interested. All right. So let's see if we can jump in here.
And just while you're pulling that up, we have a lot of people on the line here. So put in the comments where you're tuning in from. We'd love to see where everyone's coming from, and also be thinking about questions as we go along. We will reserve a little bit of time at the end for some Q&A. So feel free to put those in the chat later on. All right, Bob, let's go.
All right, that's me. And again, for those that don't know me that well, in 2001, I started I lost everything in a .com crash. And, when the tide went in and the .com boom, all boats floated. And when the tide went out, no boats floated. It doesn't matter how good your .com was in 2001, it went down. And so that was the turning point for me. It was a defining moment where I decided I had to understand what was going on in the economy. And since then, I read 2 to 3 hours a day and study and discuss with other people what's going to be happening, And it was a lot of fun, by the way. We had what's her name, the economist Ramon.
Oh, Dr. Belinda Ramon.
Dr. Belinda Roman. And oh my God, that was so fun. And we're just really in sync, a lot, very much in sync. So, all right. So this is, as Ben said, this is part of our process. So we first look at macro trends. What are the big trends? What are the big things that are going on? Not the little waves. I can't tell you what the stock market is going to do tomorrow or this month, but I can tell you some things that are very, very predictable of what's going to happen, the bigger tides. And then we identify the best asset classes to invest in and the best structures and strategies. Then we place capital and we invest in our own deals. So this is for us. Every single Aspen partner invests material in every single Aspen deal. Here's our track record. So we've raised about 250 million from investors, 600 million in assets under management, and we've returned 85 million in investor distributions since inception. So I don't know. How do you feel about that, Benny?
I like those numbers, especially the last one.
I know. And one of the things about our team is incredible breadth of experience. We started in distressed debt, but we've got a lot of development experience, a lot of experience in oil and gas, a lot of experience in hedge funds, venture capital, private equity, and real estate. So we're not the typical vertically integrated kind of operators, and we actually like that. We think having this kind of broad background gives us a lot of perspective. And I found a lot of mistakes being made in vertically integrated operations, right? If you're the multifamily guys and you've got your own property management company or your own construction company and your own, underwriting company and everything, well, then you've got to do multifamily deals to feed the engine, right? Feed the machine, whether or not there's good deals. And I find I want to be light, I want to be agile, and I want to look at wherever the money should go is what I want to pay attention to. So, all right. The Trump economy, part 2, right? Back to the future. So it's interesting. In 2017, I remember that distinctly, and I remember I should pull up my old slides, and when he announced the tax cuts, I said we are going to see an economy get on fire. And if you remember, we had 10 years of the Obama administration, the Great Recession that never quite ended. And here's a very business unfriendly president. We just couldn't make it work. And then Trump comes and, with all Trump's baggage, he understands economics and he understands business. So let's dive in. So the backdrop, Trump economy, first and foremost, all right, is tariffs. So he's talking about massive tariffs. And what those are, of course, is taxes on goods coming into America. Well, those go straight to the coffers of the federal government. So it's a huge way to raise money, but obviously there's a downside. So he's talking about as high as 25% tariffs. And it's interesting because as soon as he announced these tariffs, Ben, there's already been changes. You've seen just was it yesterday or the day before? Trudeau, the Canadian Prime Minister, resigned. Mexico, they're already talking about detaining immigrants and slowing the immigration process and cooperating. So my guess is he is using these tariffs to extract concessions relating primarily to border security and immigration. So U.S. is by far the largest trading partner for Canada and Mexico, and they're pretty much going to do whatever Trump wants. So my guess is these tariffs are not going to remain, are not going to be material, but that's a guess. I mean, I'm going to speculate here. So, but this is the assumption I'm working on. Europe.
Yeah, it seems to be consistent with Trump's process of talking big and using the leverage that we have, but then also backing down.
And if you read his book, I haven't read his book, The Art of the Deal. It's about coming on strong and negotiating. He's a master negotiator, and it works. I mean, he just rubs us the wrong way in so many ways, but you gotta. I think it can be effective. So, I mean, what's going to happen? I think we have a very weak foreign policy, and I think he's going to come on strong. We'll see. Again, I'm hoping for the best. I hope for every president, and hope for the best for every one of my leaders. Europe. So Europe, the economies are absolutely comatose. And tariffs would be extremely damaging to them. So, my guess is he will use this to extract concessions on energy imports from America. They have a real energy crisis in Europe. As you know, they've gotten most of their energy from Russia, and that has been crushed. The pipeline through Ukraine has now been shut off. The other pipelines are being shut off. They're importing from LNG, primarily from Dubai right now, and this is a huge opportunity for America. And I'm going to talk about gas down the road, but we have a huge amount of natural gas, and a lot of it's just being flared and wasted. And unfortunately, the previous administration actually tried to stop LNG and ridiculous stuff. And so anyhow, my guess is he is going to use concessions use to extract concessions on energy, on peace in Ukraine, and more spending on defense. He wants them to carry their weight in NATO. All right, now China, I think, is different. I think he might really be aiming for real tariffs in China. And if I was Xi Jinping, I'd be terrified because China's economy is in full implosion mode right now. And I'm going to talk about that in a minute. And tariffs are going to really hurt. It's a real issue. But tariffs, here's the downside of tariffs in China. If China chooses to retaliate, which they might do, which means they would put tariffs on stuff coming into China. Well, it's not a big deal for most Americans and most American companies. But look at this chart. Look at the processing. Look over to the right over here. You can see this. Look at what they process. China processes 40% of the world's copper, 40% of the world's nickel, 65% of the world's cobalt, 60% of the world's lithium, and 85% of the world's rare earth minerals. Now, none of these are rare. There's copper all over the world. There's nickel all over the world. America is rich in almost all of these things, including rare earths. They're not actually rare. But the problem is China processes it. They've set up giant factories processing these stuff. So the mines in Indonesia or wherever create concentrates, so they'll concentrate the ore, then they'll ship it to China to process, and then China process. They have these giant smelters, and they do it low cost. And the reason is they've just decided to be an industrial powerhouse, and they've decided to do this. Well, here's what happens if they decide to squeeze us like we've squeezed them with chip exports and other things that we've done. I mean, they could create a huge problem, a huge supply chain problem, like nobody's business. They could completely shut off. I mean, copper is huge. Nickel is humongous for EVs and iPhones and everything else. So all of these things. So the tariffs are a double-edged sword, and I'm not that afraid of all this. And the reason is I think Trump is quite smart related to economics and these things. So I think he's going to use it as a negotiating tool to get what he wants out of China. And so we'll see. It's a powder keg. It's a lot of risk, but China has a lot more to lose than America, as we'll talk about.
Right.
So I also
how do you feel like this would impact inflation?
Yeah, it definitely could. So there is a lot of unknowns, and this could be inflationary. It depends on how hard he goes after this. So if it's simply, to extract concessions from our trading partners, then obviously it's not going to be recessionary. If he is really a way to raise capital for the Treasury, and he's very serious about pursuing these, it's going to be inflationary. But it's not as inflationary as putting, as what Biden administration did, putting cash in people's checking accounts. Okay, it's just not that. That is about it. That's like throwing gunpowder on a open flame, right? That's what that is. This is not that. This is much more, much less. It's much more. There's a lot more upstream. Let me put it that way.
Right.
So what this will do is continue a major trend that we've been tracking for several years now, the reshoring and nearshoring trend, which I'm going to get into. So tariffs are going to, and this really is Trump's driving aim. He wants America to be a manufacturing power again, and believe it or not, America is a manufacturing power. And I can't remember if I included these slides, but we're actually seeing manufacturing jobs actually increasing, and manufacturing jobs in America have been decreasing since the 50s. So as we just continue to outsource manufacturing, but we're going to become a manufacturing power again. All right. So tax cuts. So everybody's talking about tax cuts now. And I take a very different view of tax cuts, and I've been right. I'll say it, but hey, I could be wrong, but I've been right. And I believe that tax cuts will strengthen the economy. They'll boost jobs, they'll boost equipment demand, and boost consumer spending. I don't believe that tax cuts are primarily inflationary. And again, because they're mostly upstream. What tax cuts primarily do, especially corporate tax cuts, encourage people to invest. And tax cuts to the wealthy encourage people to invest. So I think there is some inflationary pressure, but it's not going to materially increase deficits, and it's not going to materially increase inflation. Now, again, and part of that is speculation based on Trump's intelligence as an economics guy. So it depends, it depends how the tax cuts are structured and what they look like. But I've included here the Laffer curve, and this is a famous curve, and most economists believe we're on the right side. I don't believe so. I believe we're right in the middle of this. And what happens is at some point, increasing taxes does not increase revenues because you slow the economy so much, right? And at some point, cutting taxes boosts the economy. So,
spend 2 more minutes on that, because it's a little counterintuitive, right? If you think you're going to increase tax cuts, you're decreasing the federal revenue source, and they already have a deficit. So how does that not increase it?
Well, if you look at, back in the Reagan days, he cut taxes and revenues massively increased. So, and same with the Trump in 2017, the tax cuts that he did in 2017, he allowed companies to reshore their offshore earnings and gave them a little bit of a tax holiday, and the economy boomed. Well, booming economies, people pay more taxes, right?
Right.
Because you earn more money. So my rate may go down, but my tax bill went up because I made more money as a business, right? And so that's why the tax cuts are beneficial. So I'm definitely of that school. And again, you could disagree with me, that's fine. But honestly, tax cuts are generally not inflationary in the most ways they're done. I don't have a single example in the last several decades where tax cuts have increased inflation. So I don't believe they have. So I don't think they're inflationary, and I don't think they'll materially increase deficits. But again, it depends on the structure. So more to come as we see what is actually passed. The other big, thing Trump's talking about is immigration and deportation, right? He wants to stop immigration and do a pretty massive deportation. And I'm actually really not in favor of that. I think we need workers in America, and I think immigration is a good thing if it's done right and if it's done safely. And I think we should have a good immigration policy, and hopefully that's something they will fix. But it's interesting.
He's also posturing in this topic with coming in really strong, but the end result is not as extreme as he
right. And he's made comments like, well, we don't want the criminals to be here, but obviously people who are working hard. And so again, we don't know what is actually going to happen. Hopefully, if people are here and they want to work hard and they want to get ahead, I'm all for it. I mean, look at the jobs that they're taking. Look at the unauthorized immigrants. This is a great little chart. Maids and cleaners. Okay. Anybody listening on this podcast and want to become a maid or cleaner and worried about their job being taken? I'm not, so cooks, construction laborers, grounds and maintenance workers, agricultural workers, janitors, building cleaners, carpenters. We need these people. They help reduce wages. We have a job shortage in all of these areas. So I'm not super concerned about this, and I wish there wasn't so much energy on deportation. On the other hand, I believe in a strong border, and I think we should have a strong border because I'm very concerned. I mean, have we forgotten 9/11? and do we want open borders where terrorists and criminals and gangs can come through and take advantage? So heck no. So I'm very strong border, and I'm very pro immigration. Can you be both? Absolutely. And I think we should have pro immigration. But anyhow, so I'm a little concerned about this, and I'm hoping it's a lot of rhetoric and not as deep, as he thinks it could be. Energy policy. So he made the comment, drill baby drill, right? We're going to start drilling. Well, the reality is this is from Exxon. This is a quote. We're not going to see anybody in, quote, drill baby drill mode. Liam Mallon, head of Exxon's upstream energy division, told the Energy Intelligence Forum in London. A radical change in production is unlikely because the vast majority, if not everybody, is focused on the economics of what they're doing. That's absolutely right. And so we did see in the 90s, we saw the drill baby drill, as we saw, the energy explosion in America, where America became the world's top oil producer. And it was indiscriminate. And then we saw, in 2016, the Saudis had enough of that and crashed the oil market. And since then, oil drillers are very disciplined. Pretty much no one is in drill baby drill mode. And if they wanted to be, they can't get the funding to be. So the exciting thing for me, I think strategically, I think, natural gas is a huge resource for America. We have incredible amounts of natural gas in America. And a lot of that gas, like the Permian Basin, the giant Permian basins in Texas, almost all that gas is flared off because there is no offtake infrastructure. And it's horrible. Why can't we create LNG? And one of the things Biden did, which just boils my blood, is he stopped the building of LNG terminals. Now, what LNG is liquefied natural gas, where they cool it, they compress it, cool it down to minus 250 some degrees. So it's basically extremely cold, and then you can ship it. And it's the cleanest of all fossil fuels. It has far less carbon than every other fossil fuel. The U.S. is massively oversupplied, and here Europe is starving for natural gas. Are they our allies? Do we want to help our allies? We should be cranking up LNG as much as possible. Stop flaring, and crank up LNG production and shipping it to Europe to help these guys.
Prices are 5 to 10 times higher in Europe than they are in the U.S.
It's not quite
just
that
a little
much,
bit.
Yeah, it's like 3 to 4 generally, and what's more is it's hurting their economy, where the businesses that require any energy cannot get cheap energy. Plus, it's energy security. Russia is using gas and oil as this gun to Europe's head. So are these not our allies? Do we not want to help these people? And number two, help ourselves as well. So it was so stupid. The previous administration is just completely dumb, in my opinion. It's nonsensical. It was more religion. It was the carbon religion. But even that, it's not even true to the religion, because if you really believe in decarbonization, natural gas is the best way to do that, to bridge there, because it's the lowest carbon fuel. It generates 50% less carbon than oil, because it's a very simple molecule. A natural gas molecule has one carbon atom and four hydrogen atoms, which is clean. So it's very, very good. Anyhow, so the energy policy, I believe, is going to boost our GDP, quite a bit, and having an energy-friendly, administration, I think, is going to be very good. All right, Doge. So this was a great idea. I'm optimistic.
This is not the coin, right?
Not the coin. Department of Government, what is it? Expenditures.
Efficiency, I think.
Yeah. So I'm hopeful. If you look at what Musk has done, how many companies does he own? And he's completely revamped these things the guy is a one of a kind. Can he do pretty brilliant things? Is it possible? Well, I think that's proven. So now the government's a very different deal, but I'm going to give him the benefit of the doubt. I think it's possible. I think he's going to have a lot more luck in reducing bureaucracy and regulation than in reducing spending.
Right.
And that's all good. I mean, bureaucracy and regulation, getting rid of some of those things, I think is a plus. But the reason I think I'm less optimistic about spending is that if you look over here at the budget, the mandatory spending, this is the mandatory spending, this outer circle here. You can see, and most of our spending is mandatory. It's Social Security, Medicare, Medicaid, income security programs, and other. You can't touch it. You can make the Social Security Administration and Medicare Administration more efficient, but you really can't touch the money going out. And then here's net interest. This is the inside one. And here's discretionary, non-defense is about 1 trillion, and defense spending is about 1 trillion. So this is the discretionary stuff. So I think it's very difficult. But I'm going to give him the benefit of the doubt, and I think it can have a very positive impact, and we'll see. Right. All right. So that's the Trump backdrop. Let's look at the consumer still powering the U.S. economy. So this is, how many times have I showed this chart? So this is consumer spending, and the reason this is always my first chart is because this is 70% of the U.S. economy. So as long as this chart is looking good, the U.S. economy is going to look good. That's why back, 3-4 years ago, when everybody was saying we're going into recession, I said we will not go into recession. And I nailed it. I was one of the only guys that I can remember saying we were not going to have a recession. And it was based on this chart. And here's what's happened. So this is the Obama years. This is consumer spending, and it just goes up. Here's COVID here. This little dip, and post COVID, consumer spending has been on a rip. And I keep waiting for this to turn. Right, I keep waiting for it to turn south. Well, and now it's on rip part 3. People are spending. Now this seems incongruous, right? Because you hear about people, the dollar store and Walmart saying, people are under pressure and inflation is hurting people. And that's true. Those things are all true. It doesn't change the fact that overall consumer spending is on fire. And so the lower quartile, the way you can think about it, this is to break these consumers down to quartiles. The lower quartile of earners, the poorer folks, they're struggling mightily.
Right.
But the rest of the people, the middle class, is doing quite well. And you've seen a lot of things happening great. But the job market is strong. Wages are high. Wealth effect with other things. So this is still going on, and it's still powering the U.S. economy. Individuals are still sitting on record cash. This is household check deposits. Checking accounts of households. So look what happened. 2010, COVID here, boom, $4 trillion in new capital sitting in checking accounts. So people are flush. We wonder who those guys are. Where are they? But
to your point, I think what so many people get sucked into is the headlines of, that bottom quartile, because that they are really struggling. That they are being impacted the most, but at a whole, at an economic and GDP economy level, this is what the numbers show.
That's exactly right. And it doesn't, we don't want to be insensitive to the issues. That's a lot of pain. But on the other hand, I'm not calling that. I'm calling the economy here. And all right, it's consumer savings. So we saw consumer savings spike up. This is the COVID spike. And since then, it's been at a much lower range. So was
just a savings rate, so percent of income they're saving.
Yes, right? So it's 5% versus it was higher than that before, but it's not too bad. So consumer savings has definitely been hurt by the by the inflation. Consumer debt. So this is the delinquency rate on single family mortgages. It's so funny when I say, yeah, we're in distressed debt. Everybody says, oh, that's got to be a good business. I'm like, no, it's a dead debt. Look at this defaults. So this is the 2008 crisis where we saw the defaults happening. And, we're just, no, people are paying their consumer debt, their residential mortgages. This is household debt service as a percent of disposable income. This is how much money they pay of their disposable income. What percentage of their disposable income consumers are paying to maintain their debt? This is this one down here. Well, not that much. It's not that bad. And this is total financial obligations, not just debt. Again, it's pretty low. I mean, this is the COVID spike. People paid down their debt. So it's still, again, people are not under pressure. Why is this? Because a lot of people are the bulk of people's debt they're carrying is their mortgage debt, which is still locked in at these very low rates. So,
I'll make one more comment here because I see a lot of people put out the credit card debt chart, right? And we've seen credit card debt spike. But you have to take it into context of, and you'll show this in a minute, I believe, is real wages have increased. And so you want to look at it as percentage of income. And we're seeing here as a percentage of income, their debt service.
And this includes the credit card debt. So this is what I'm saying. Yeah. This is where a lot of times people, you've got to know what to look at when you're listening to the headlines, because there's always another headline that's alarming, right? But how big is it and how important is it? So what I'm doing here is I put everything in context, and then I figure out how important it is, right? All right. The wealth effect. Now, the wealth effect is when people feel wealthy. And this is based on net worth. And so this is household net worth. And you see what happened here. So this is, again, COVID boom. Household net worth just skyrocketed. This is because of housing prices jumped up. The stock market jumped up. The, everything jumped. And this is real net worth. This one here is and so real net worth means adjusted for inflation, And real net worth is up 30% since 2019. So people are feeling wealthy. This means their homes they're sitting on equity in their homes. Stock market has gone up. So the net worth of people has gone up. So again, I'm waiting for these charts all to turn, right? I pull these every quarter and I keep waiting for something to turn, and nothing has turned yet. A few things. I'll show you a few things here. Real income. Again, this is real median household income. So this is real means adjusted for inflation. So we saw, Obama years sucked. As soon as we saw, well, this is the great financial crisis, sorry. And then here's the Obama years, real household income rose. Here is, we saw it go down, some during COVID, and it's still up 23% since 2012. So wages have been fairly strong and even against inflation. So it's continued to beat inflation. US dollar, and I've been saying, I said 20 years ago, the US dollar is going to be the world's strongest currency for the next 20 years. I said it 10 years ago, it's going to be the strongest for the next 20 years. And I'll say it again, 2025. It's going to be the world's strongest currency for the next 20 years. And don't let anybody, show you, talk about the dollar circling the toilet bowl and bricks and all that. It's not going to happen. Here's the dollar. I mean, we have the only strong economy in the world right now. We have the strongest stock market in the world. We have high interest rates right now, which attracts capital. And the rest of the world economies are comatose. Everybody says, well, what about everybody hates the dollar. Americans seem to buy into this negative dollar scenario. I'm like, okay, well, which currency do you like better? Do you want to buy the loonie, the Canadian dollar? Do you want to buy the Chinese yuan controlled by the Politburo? How many of your billions are you going to put in there? Right. The truth is America is the strongest destination, and there's no chance of this changing in the next 20 years. Not a chance. Economic growth has been strong. So the blue here is GDP growth, and we're seeing, since COVID, 3%, 2.5%, 4%, 1.5%, 3%. So these are really strong growth. And I put this against the Fed funds rate here. This is the red is the Fed funds rate. The Fed started raising rates, and it didn't change a thing. We've seen really strong growth. I'm predicting, again, quite strong growth. We're going to continue to see 2.5% to 3.5% GDP growth per year, very strong. And primarily because Trump is a pro-business president and is going to enact pro-business policies. And he is, unlike most of our politicians, I believe we should require politicians to take economics 101, and because they're so idiotic in some of the policy decisions. And Trump is actually quite intelligent in economics. So oil, what about oil? Well, near term range bound. So I'm seeing right now here on the demand side, US demand is strong, but if you look in, China's demand is weak, European demand is weak, and the rest of the world is kind of medium. So supply continues to be constrained. So we have a supply issue, but we also have the demand is weak. So at this point, oil is going to be range bound, which means buying opportunity, because long term, and I'm going to talk about oil a little more, long term, oil is in a massive supply constrained problem. And so right now, because demand is weak, that's called a buying opportunity. So time to be accumulating oil assets. Here is crude prices recently, and here's the range. You can see, and I think we're gonna continue in this range more or less. Let's say between $60 and $90, $60 and $85 maybe. Jobs. So this is one of the things that has been changing. So the job market is still warm, but it's cooling. So job openings, for the first time, the unemployment level has actually risen above the job openings level. So we had a huge problem where the job openings, the blue line here, we had more job openings than we had unemployed people. And it just says really a labor shortage. We see that finally the labor market is more or less in balance. Now, I'll say this, I'm a data guy, but I'm not sure I believe this data. I think the job market is still quite hot especially for certain jobs, right? For certain, high, white collar jobs, et cetera. So we'll see. But I don't think this jobs are going to be producing the kind of inflation that we have been seeing. So, all right.
Do you know? I mean, it's hard to tell if this is more skilled labor versus unskilled labor.
This is everything.
I know, but what do you think is driving that kind of more normalization to an equilibrium here? Is that the unskilled labor has kind of caught up through the
I think we've seen we've seen the jobs being filled, right? The jobs have been more and more jobs are being filled, and fewer people are coming back into the job market. So I think it's just coming into equilibrium. I also think there's a lot of jobs that are disappearing, from AI, right? And those kind of things. As always, right? There's always this disintermediation of a job market by technology, robotics and other things. So I just think it's. I mean, everything normalizes, right? The best solution for high prices is high prices, right? The best solution for low prices is low prices. So everything normalizes, and if you can't hire people, you find other solutions, and if people are very, very inexpensive, very cheap, well, then you hire more people, and so everything normalizes. All right. So I never opine on the stock market. I'm not I just keep minimal wealth in the stock market. But I thought I'll do it. And so this is from J.P. Morgan, and this is a study that I've done myself and pulled all the data. And I love this, but I didn't do. This is from them. And so what this shows is the forward PE and subsequent 1-year returns for the S&P 500. And so basically what it says is this: it's like when the stock market is based on how highly valued it is, determines the returns over the next 10 years, right? Or next 1 year. And you can see there's the pretty good trend right here, right? On the 5-year return.
So that's
so it means
5 years
right,
following the date, right?
Yeah. So if the forward PE is 11x, you can get pretty sure you're going to make 15 to 20% returns in the next 5 years because the stock market's cheap. When the stock market is really expensive, when it's out here, 26x, you can be pretty sure it's so highly valued, you're probably not going to make as high returns. Well, so the fact that you can see right here, pretty accurate. And where are we now? Well, the little red dot here, 22x. So the market is in nosebleed. It's hard to invest in the stock market right now for me. So looking at 5-year returns of maybe under 5%, which would be pretty sucky. And we've had, of course, the last 2 years have been insanely good for the stock market.
Right.
Well, that's almost a sure sign that the next won't be, right? Because, so everything equalizes. And unfortunately, people tend to follow markets and time themselves wrong. But all right. Okay. 2 of the megatrends. Number 1, inflation, softer, but still stubborn today and problematic tomorrow. So long-term, we're going to continue to have inflation issues. Today, I think we're not going to see a lot of inflation issues, but it is going to be stubborn. It's not going to go down like people think, but it's also not going to go up very high right now. Right. Tomorrow, a few years from now, we are going to see a very stubborn inflation problem. So here's core PCE and PZE. This is the number the Federal Reserve looks at. And we've actually seen it ticking up slightly, core PCE 2.88%. They want to get it down here at the 2. It's not quite there. And here's inflation's 2 dirty secrets. And I've never seen any other economist talk about this, but I'm telling you, I don't get why, because to me, this is everything. To understand inflation, you have to understand the drivers of inflation. And there's 2 hidden ingredients in inflation: labor and energy. And labor is not part of the inflation indexes. And neither is energy, except in a teeny tiny way. But what can you do in the economy that doesn't involve labor or energy? Nothing. Right. So they're the underlayment of everything. And I can show you, there's the black line here is the oil price. And here's this consumer price index, inflation, the yellow line. Do you notice the correlation?
Pretty tight.
Right here. Oil prices rose, inflation rose. Oil prices cool, inflation cools. Hello. And here it is laid against wages. CPI, again, the black line is wages. Do you notice anything? Hello, wages. Hello, wages. So this is everything. And I'll say cooling for now. And this is because of my oil prediction and because of my labor prediction, which is cooling. Both of them are right. Going to be in control. So inflation is cooling for now, but long-term is problematic due to energy and labor constraints, which I will talk about. And we have issues. We have energy issues long-term, and we have labor issues long-term. Trump policies may increase the inflation. And any economic recovery in China or Europe will bring inflationary pressure, primarily because they'll increase oil prices. So As long as these are cool, I think we're fine. All right. Megatrend 2, and this is a brand new one. Era of higher rates, cheap dead ends. This is not good news. This, I don't like this one, but I got to call it. So this is the federal surplus or deficit. So, do you notice anything?
Looks kind of one directional there recently.
Well, and just the size of it is insane.
I know.
I mean, the deficits that have been running, and here's what people don't think about: it isn't just the deficit. So whatever deficit we run means your spending minus your tax revenues, you have a deficit. Well, we borrow for that. And this is the treasury market. This is how much we've been borrowing. Okay. And I put presidents in here. So the Bush administration, this is what we were borrowing, roughly the size of the treasury market. This is gross treasury issuance. This is how many treasury bonds are being issued. And if you have a bigger deficit, you have to issue more bonds, more debt. And then during the Obama administration, while he decided that, let's double our daily issuance of treasuries, Trump increased it even more. And then Biden, this was insane what has happened here. In the treasury market, well, what happens, that's a supply and demand problem. So this is the treasury supply, right? So who's buying all these bonds? That's the question. I've actually studied that, and it's not one outsized buyer. I don't have a chart for it, but we are seeing more and more supply. And what that means is when you have more supply and less demand, or the same demand, and demand has been increasing, but not at the same rate, you'll see rates increase. So you'll see prices increase. So that's the backdrop. And I said mandatory spending, it's going to be very, very difficult to bring this down. Furthermore, we have, the mandatory spending is a lot of it Medicare and Social Security, but you look at the deficits. We are running deficits, and it's only getting worse because of the aging of America, right?
Right.
Yeah. So we're seeing, all right. Jamie Dimon, who's JP Morgan's leader, says we might see interest rates spike, and these are the things he mentioned: the green economy, which is way more expensive than anyone will admit, the remilitarization that is happening and needed, and the restructuring of global trade. Coming energy crisis, I'm going to hit this real quick. So this is, energy supply and demand. And this is supply with no investment, is the green here of oil. You can see down here. This is investment in existing fields. And then this is the new resources needed. So, and we have a huge problem. There's not enough investment, has not been made in oil exploration. This is natural gas, very, very similar situation. And here's the problem. We normally spend about $3 trillion a year in oil and gas exploration. We're down to less than half that. There's not been enough money spent in oil and gas exploration. The problem is every oil field runs out of oil. Unless you're exploring, you're in trouble. And this is why I believe that we're going to have a major, major energy crisis sometime in the future, not in 2025, which is great news. Right. So it's time to be buying.
Time to be buying.
Time to be buying. And this is the perfect Goldilocks buying opportunity for oil and gas. People think, it's amazing to me how uninformed people are about green energy. People think, aren't we post fossil fuels? We're 83% carbon today, right? And transportation, by the way, is 91% carbon. 91. Airplanes. When have you seen an electric airplane? Ship. How about electric ships? How about electric, over-the-road trucking? How about electric trains? We're just not seeing these things. And the reason is there's not enough energy density, right? There's just not in lithium or anything. Oil has an enormous energy density. So,
and not to go back to the whole rare earth minerals and all the other things that China controls supply of, that's another big challenge to accelerate the EV and battery production. Right?
Yeah, I wish I was wrong. I wish we were further down the road, but windmills are not the answer. They're not even net zero carbon. People don't realize how much it costs in fossil fuels to make a wind turbine and to keep it running. So
Now, like quick interjection here, because we are going to be doing a webinar here in a few weeks just on oil and gas predictions for 2025 and talking about where we're seeing opportunities. So
Good.
Be sure, if you're not on our list, to get on the list, and we'll be sending more information on that soon.
So JP Morgan is predicting a supply deficit in this year widening to 7 million barrels per day in 2030. So we'll see. All right, Megatrend 4, China apocalypse. This has been amazing to watch. 2023 was the year China's economy was supposed to come roaring back. Instead, we've seen, falling exports, deflation, a property bubble popping. China cannot cut rates due to debt concerns and currency concerns. And we've seen a crackdown on the private sector, and accelerating deglobalization, which is China is just, they're going to have the worst decade ever. According to the Wall Street Journal, we're seeing, something like they've seen, like our great financial crisis in 2008, theirs is greater. 18 trillion right now has been lost in China, in China's property.
Wow.
There's been a huge debt bubble. 85% of these local financing vehicles is 80% of the debt is in these vehicles. A third of China's major cities are struggling just to pay the interest on the debts. And we're seeing as much as 90 million empty housing units. 90 million. That's almost over half of the entire housing units in the United States.
Right.
20 million unfinished units. Chinese people had 78% of their wealth tied up in residential property, hundreds of entertainment complexes, ghost cities, and abandoned roads and bridges. And the projects are all funded by these local financing vehicles. And they turned out to be ill-timed, ill-conceived, or both. Hello. When you get a centrally planned communist government deciding how to invest, right?
Yep.
It's the worst kind of thing. It only ends one way. It's Russia proved it, Cuba proves it, Venezuela proves it, China proves it. Centrally planned economies are just this very stupid idea. Why do we think a bureaucrat knows what to invest in, right? 400 to 800 billion at high risk of default. Beijing could either pay for bailouts, which might create a bigger problem by encouraging unsound borrowing, or it could allow insolvent funding vehicles to go belly up, exposing Chinese banks to serious losses and potentially spurring a credit crunch that would further erode economic growth. So if that isn't bad enough, we've got this demographic collapse. What this shows, this is the total population of China. And we're seeing by the end of the century, China's population dropping by 50%. 50%. Insane. This is their working age population, the 25 to 64, right here, dropping by 2/3. 2/3 of their workers disappearing. Their economy is in shambles, and they are going to be a second-rate, third-rate power in no time. Anybody who's banking on China is placing the wrong bet. Deglobalization. Suddenly in 2020, supply chains had to be risk, and now supply security is paramount. Add tariffs. So this is trade as a share of GDP, and you can see it peaked right around 2010, and it's been dropping. So trade is less of a contributor to our economy than it was in the past. And this is the chart that shows deglobalization. So it's not rapid, it's not brutal, but it's happening. So we are seeing the world deglobalize. The world is over globalized. As you said, they've underpriced a risk of supply chains and these kind of things. What's more is China is seeing its days as a manufacturing titan are past. I mean, it is going to continue to be a manufacturing titan, but this is China's wages. This is Mexico's wages.
Yeah.
So China's in trouble. huge reshoring and nearshoring boom. This is one of our favorite mega trends that we just continue to play. Industrial real estate will be the first beneficiary, but this boom will affect every area of the economy. We're going to see secondary and tertiary markets, which is primarily where the manufacturing boom will take place, continue to boom. We've seen a rapid urbanization of America. We're going to see a slowing of that trend and kind of a de-urbanization, where we're going to see, second tier and third tier markets are going to continue to grow. This is reshoring job announcements. This is the amount of jobs announced in reshoring. This is construction. This is manufacturing facilities. Percent of companies actively reshoring. 90%. Reshoring trends. It's cheaper to manufacture in the United States for 32% of companies. It's actually cheaper to manufacture in the United States when counting for TCO, which means total cost of ownership, logistics, quality control, inventory management, other risk factors. 46% when counting for TCO and 15% tariffs.
Right.
So people don't realize how competitive America is when you add, everything: quality, inventory, risk factors, tariffs. U.S. factory spending has nearly tripled since 2021. This is construction spending for factories. Monumental growth in domestic manufacturing is underway. I don't know, you want to comment on this at all, Ben?
No, I mean, the trend's clear. I think Trump is only going to accelerate what we've already been seeing. For your point, it's been happening for about a decade, and it's been a little bit of a slower, deglobalization trend. But I think we're going to see that really accelerate over the next couple of years. And
yeah,
I think $1 trillion spent last year or 2 years ago on that.
Yeah, and you're looking. These are lower wage markets. A lot of these, they're business friendly markets, as the South and the Rust Belt. Continues to be big hotspots for growth spending. Construction starts in industrial are way down. So we've seen everybody going pencils down. Not Aspen. We're busy, looking at this. Commercial real estate opportunities. So we're seeing, commercial real estate. We just always have loved commercial real estate. Office is not an area that we're playing in. At some point, somebody is going to be buying office and they're going to make a gob of money in it, but I'm not going to be that guy.
Yeah, not yet.
Not yet. You can see delinquency rates are steadily rising in lodging and in multifamily, not in industrial. Industrial is by far the healthiest. So we are seeing this. We're seeing, we talked about this a year ago. The lenders are primarily extending things and extending terms. We're seeing delinquencies rising, but they continue to extend terms. Meanwhile, we're seeing lots of dry powder, lots of money behind all this, waiting for prices to drop, which means we're not going to see values drop much because there's a lot of people waiting in the wings for this distress, which we've not seen happen. And cap rates are fairly stable, trending down slowly, but unlikely to drop to previous levels. Again, based on the 10-year, we're seeing it rise. I think we do have some risk of cap rates staying where they are or rising slightly. I think most people believe the trend is down. And I say it's probably down to sideways, but it could go up. Number one opportunity in my book is industrial. It's extremely healthy, plays the reshoring trend. Deliveries are down, absorption is rising, and the market flipping in 2025 from surplus to shortage. And the cap rates are very stable and falling. So there's the cap rates. You want to comment on this?
Yeah, I think we don't have a lot of time here. We'll get some questions, but I think the trends you just described there are exactly right. It's had a little bit of a delivery boom of a new product being delivered the past few years, but that's very quickly being absorbed, and the construction has fallen off quite a bit in new starts. And if we see a pickup, even just the same trend of reshoring that we already seen, there's going to be a huge need for more manufacturing, more distribution, warehousing in the next year or so. And most of the predictions are saying by the end of 2025, mid of 2025, we're going to actually flip over from surplus to shortage, and especially in the tertiary markets where it is a lot cheaper to get more blue collar labor that's very reliable. And so we're actively playing that. From an investment standpoint, I think it compares way more favorably than other real estate asset classes because of the simplicity to build. You don't take as much risk on the construction, and usually can get institutional quality tenants if you're building the right building. So a lot of reasons to like it.
I'll let you hit this one.
Yeah. So, we've talked a lot about, multifamily meltdown, quote unquote, over the past year and a half. And, things have started to, potentially hit a bottom. We've seen values come down 25, 30%, depending on who you ask. And, a lot of what's happened so far, like the big apocalypse that people thought was going to happen with the maturity wall and, all these loans that are, not hitting their debt service coverage or their covenants, and, going to cause this huge domino effect. We said that originally that it's going to be more pockets, right, of distress, but because there's so much capital on the sideline waiting to jump back in, it's not going to be this massive reset in multifamily. That said, it's still time to be cautious in multifamily. I agree with you. I think we're still at risk for cap rate expansion, right? Not compression. I think if the rates maintain, the long-term rates maintain, higher levels, that's going to continue to put pressure on cap rates. And right now we're seeing, pretty much flat or negative rent growth, depending on what market you're in. So, my perspective is in the short term, it's going to be very choppy, right? We're going to continue to have deals going from distress to foreclosure. We're already seeing a lot of that. But long term, we still have a housing shortage. So there is strong demand. We actually saw that, interestingly. We have a chart here. If you want to go to the next chart, in 2024, absorption actually exceeded the deliveries, which was a record, right? And so there's still demand there, but the challenge is in the short term, there's so many things going on that you gotta tread carefully. But I think if you have a long-term time horizon, I would say at least a 4 to 5 year time horizon, you're probably in a good position, buying at a good basis with solid debt at a low leverage point. You should be good. The way we like to play this, when I go to the next slide, is really from a credit perspective of going lower in the capital stack to where we can
reduce
get
your
a fixed
risk
rate of return.
Lower in the capital stack.
Yes, and you reduce your risk to cap rate expansion, right? You have a lot of other rights as a lender, preferred equity investor. So that's the way we see it being really the best way to play, because you can achieve pretty incredible rates as a preferred equity investor, given the challenges that the lending and capital markets are seeing. So
yeah. So and the way we want to play this, like I said, is private debt. So we started a private credit fund. We love this fund. You can see this is the amount of, look at the blue is private credit versus bank loans. So private credit has really become a major lender in the space as the banks have just dragged their feet. And so we have a private credit fund. This is the best way in our book to play multifamily, but I think it's a selective opportunity. And, but a lot of the deals we're looking at that we've been underwriting recently, Ben, are not deals I would want to put $1 of equity in, but I love putting in debt into these deals.
Yep. All right. Well, we made it through. And a little bit over time. We still have a lot of people on the line, so obviously people were interested and engaged.
Yeah, let's take some questions.
Let's take some questions. We have a couple in here, so encourage you, if you have a few more minutes, we'll stick around for about 5-10 more minutes. Put those in the comments, and we'll come to those. Can you scroll up, Sam? There's a couple that I saw was good. One, I saw we got a couple votes for Bob as president and Bob as Fed chairman. So be sure to vote for him the next terms.
Be sure and write me in.
Yeah, right. Okay. What are your feelings about the impact of the growing U.S. national debt and interest payments? Barry, great question. Thanks for putting that in here. What do you think, Bob?
Yeah, I think the primary impact, again, a lot of people are talking about dollar crisis and all this. It's not going to happen. there was a great study by Carmen Reinhardt and Kenneth Rogoff, they're Harvard economists, who looked at high debt to GDP ratios and the number of the countries that defaulted, and countries don't default. The way we get rid of the debt is inflation. So even 6% inflation just wipes out debt. Inflation is a massive transfer of wealth from savers to borrowers. Well, who's the biggest borrower? The United States. And so that's the way it's going to be solved. But what it will have is higher interest rates, and that's why I showed the chart. So I don't believe there's a systemic issue, but it is a problem that we need to solve. We need to start to live within our budget or closer to it. And unfortunately, we have
up to this point, we haven't seen massive softness in the treasury markets, but we have seen a little bit. And if we continue to increase the deficit and increase percent of as a percent of GDP, maybe demand is less for our bonds than it used to be. And the way you compensate that is higher interest rates. You got to pay more interest to attract that capital. And so another reason why long-term rates might be higher. Yeah. All right, Shandor, great question. And hey, Shandor, Elon talks very seriously about paying off national debt. How will this impact the economy if his influence with Trump makes this happen?
Well, the problem is that bonds are the plumbing of the world. So what is China going to buy, or every nation that runs a current account surplus? What are they going to buy to backstop their currencies? So, I don't know how he can be serious about that. Number one, we can't afford to. Number two, the world doesn't want that. I mean, one man's debt, the government issues as debt, another man buys as an investment. And so debt is not evil. It is every dollar of debt is someone else's asset, right? And savings. So it's not realistic.
What I do think, obviously, Trump and Elon are aligned on is they want to incentivize growth with the tax cuts and manufacturing. And if we could increase our GDP, that increases our tax revenue, which can hopefully decrease the deficit. And over time, we kind of earn our way out of it. And if we have some inflation, that'll obviously benefit the federal government as well. But yeah, we don't have the ability to pay off the current deficit right now. Walker, hey Walker, great question. If cheap debt is ending, puts that in air quotes, what does that mean? Will it be normal or high? What are those rates? How will this impact ground up construction? Well, you're asking the right guy, because Bob has read the history of interest rates since, what was that? The 2,000 years of interest rates. So.
Yeah. What are high rates? People think rates are high because they're at 6%. Well, historically, for the millennia, do you know what rates were? Around 6%. So it depends on, of course, it depends on what kind of debt you're talking about, right? All the, what rates you talking about? There's 100 rates, but I think we're going to see rates where they are right about now. I think we're going to normalize in this area for a while.
Yeah.
We're seeing mortgage rates in the 7s. I hope that comes down. I think it will. Commercial rates, anywhere from, we're seeing, agency debt being low 6s right now. I think it'll ease a little bit from there, but it might not. I mean, again, it depends on the spending. So,
yep. And how it impacts construction, I think is a great question. What we're seeing is we do a lot of construction deals and we see those. What ends up happening is if you have a higher borrowing cost, obviously it reduces your margin. And what a lot of times happens is it just reduces the amount of construction that can happen, right? Because it's hard to form capital. It's expensive to form capital. I think if we have higher rates, it's going to force a lot of people out of building, if they can't achieve the yield they need to achieve. If inflation continues, I think it'll increase that potential total yield on costs that you can generate from construction. But higher interest rates are definitely going to keep construction slower, in my opinion. I don't know if you'd comment on that, Bob.
Agreed.
Yeah. Francois, hello. How are you? What is Bob's view on cryptos 5 to 10 years?
Yeah, that's great. And, I'm a computer scientist, so I actually study cryptos for fun. And You need to read my book, Invest Like a Billionaire. I just finished it. It'll be coming out here this year. I talk about crypto, but there's only one crypto that that's actually investable in my opinion, and that's Bitcoin. And because it does have a value as a currency, and it is limited in its value, but it does have some, and it has limited supply. So as long as it has any demand and this limited supply, it's going to go up. So I think it's a decent investment. I would not make it a core investment. But yeah, the others are, everything is problematic and for different reasons.
Yeah. Got a couple other here. Chris Wilson, you're saying, what's this one? Well, extend and pretend fall apart in 2025.
Right. And this is, the especially you're talking about commercial lenders.
Yes.
I think you're going to see it. I think you're going to see it fade out. I think it fades. I think more and more deals are being worked out. I mean, we've seen a lot of distressed deals that, they're giving up. A lot of sponsors are writing checks every month, these deals, and they're just saying, I'm done. And the investors are taking wipes, and a lot of deals are getting cleaned up.
So I think what's different than from 08, I mean, not to go too deep in the weeds, but there's not a banking crisis right now. Banks are generally fairly healthy. And what we're seeing is it's a lot more idiosyncratic with what's the lender's preference. Are they going to be aggressive and foreclose, or are they going to work with the borrowers? I think the type of lender matters a lot. I think bridge lenders that are debt funds, some of the big ones like Arbor, they're really struggling in their the publicly traded security side of it, and the valuations have come way down. I think they're having to be a lot more aggressive. So I think the type of debt really matters, the type of lender you're working with. I think more regional lenders, agency lenders are a lot more willing to be flexible. So a lot of that depends. But again, there's a lot of cash on the sideline. So if there is distress, most people are not going to see it because it's going to get picked up and scooped up before it ever hits the streets.
But are lenders incentivized to extend? Of course they are. So, they don't want to, but again, to your point, it's never systemic, meaning going to crash the system. It was never that. The only time a financial crisis becomes systemic is when they become banking crisis. And this is not even close to a banking crisis. So it's not systemic. I do think it's going to continue to extend, and I think it's just going to fade. Less and less extensions and more cleanup.
Yep. Chris, it sounds like Aspen will be focused on commercial real estate and oil and gas in 2025. Are there other opportunities that you're focusing on? Those are the two biggies. And there's obviously multiple verticals and strategies we have in the commercial real estate side, and we are very bullish on oil and gas. There are things down the road we're looking at. Nothing that is well formed enough right now to put in front of investors, but
possibly distressed debt. We're looking at a pool there. I'm looking at private equity. I've been looking at some companies. I haven't told Ben this yet, but a company that was developing data centers, very cool model. So there's some things we might do down the road.
Even a bank we've talked about, right? Which is something we're excited about down the road. Yeah. So, Cameron, last question here, and we'll log off. Any comments on rent growth, stagnation, decline projections across the next few years for residential and multifamily housing? Yeah, I mean, we kind of touched on it a little bit. I think the surprise this year, at least for me, was seeing demand actually was higher than supply in 2024. So the net absorption was very, very strong. And I think that's driven by a few things. One, a housing market that's very expensive right now with mortgage rates and prices. That's keeping a lot of people in multifamily as renters longer. And then I also think there's more household formation. I've seen some data that had very strong household formation last year, which creates new renters into the market. I think long term, we're still of the belief that we have a housing shortage. I think in the short term, it's going to be flat. And a lot of that's going to depend on the supply in that market. In the Midwest here, we're in Kansas City. Bob's in Colorado, but I'm in Kansas City. We actually had, I believe it was 4% rent growth in 2024 in Kansas City. Meanwhile, most of the Sun Belt markets had
Right. It's a very regional. I would not want to be. I would not want to be in Dallas right now. Some of these big metros. There's still way too many deliveries. A lot of the Florida cities. There's a lot of cities that I wouldn't touch with a 10-foot pole. And then there's a lot of cities in the Rust Belt and Midwest that are having very high rent growth. So
yeah. But I think 3, 4, 5 years from now, I think we'll see a tick up as there's a normalization. So again, time horizon really matters, and good basis always matters, and really good debt always matters. So if you have those 3 things, I think you should be good. All right, guys. Hey, thank you so much. This was really good. Bob, thanks so much for putting this together. Hope you guys got a lot out of it. Again, if you saw in the chat, we have a link for Investor Club. If you're not already signed up for that, be sure to do that. You get kind of first access to deals that we launched. We have several things teeing up in the first half of the year here. So definitely be paying attention, and be sure to get on the inside if you're not already. So thanks so much, everyone.